The COVID-19 pandemic has disrupted the global economy in unprecedented ways, causing widespread job losses, business closures, and supply chain disruptions. While the rollout of vaccines has enabled some countries to resume economic activity, the recovery has been uneven and uncertain. Moreover, the pandemic has exacerbated pre-existing vulnerabilities and inequalities in many sectors and regions. Against this backdrop, some experts are warning that a recession could occur in 2023 and that it could be worse than the 2008 financial crisis. In this article, we will examine the reasons why some experts hold this view, the potential consequences of such a recession, and the possible ways to mitigate its impact. First, let us review the main causes of the 2008 financial crisis. The crisis was triggered by the collapse of the subprime mortgage market in the United States, which had been fueled by excessive risk-taking, lax regulation, and financial innovation. When the housing bubble burst, many banks and financial institutions that had invested in subprime mortgages suffered huge losses and liquidity problems. This led to a credit crunch, a contraction in lending and spending, and a global recession that lasted for years. The crisis also exposed the interconnectivity and complexity of the global financial system, which made it hard to contain the contagion and restore confidence. Now, let us consider the factors that could lead to a recession in 2023. One of the main concerns is the high level of public and private debt that has accumulated in many countries and sectors. The pandemic has forced governments to borrow trillions of dollars to fund their stimulus packages, healthcare systems, and social safety nets. While such borrowing was necessary to prevent a deeper and longer recession, it has also increased the debt-to-GDP ratios of many countries to record highs. This could limit their fiscal space and trigger a sovereign debt crisis if investors lose confidence in their ability to repay or service their debt. Moreover, many companies have also taken on more debt to survive the pandemic, which could make them more vulnerable to bankruptcies, defaults, and credit downgrades if their revenues and profits do not recover as expected. Another concern is the potential for a global economic slowdown, which could be triggered by various factors such as rising inflation, interest rates, or protectionism. The pandemic has disrupted global trade and investment flows, and exposed the vulnerabilities of some supply chains and sectors. This could lead to stagflation, a situation in which prices rise but growth stagnates, which would hurt consumers, producers, and investors alike. Moreover, geopolitical tensions, such as those between the United States and China, could also affect the global economy by reducing confidence, increasing uncertainty, and triggering conflicts that could escalate. If a recession were to occur in 2023 and be worse than the 2008 financial crisis, it could have severe consequences for many people and countries. For example, unemployment could rise sharply, poverty could increase, and social unrest could occur. Moreover, the global cooperation and coordination that helped mitigate the impact of the 2008 crisis could be harder to achieve in the current context of nationalism, populism, and polarization. The crisis could also exacerbate the climate emergency, as investments in renewable energy and conservation could be reduced in favor of short-term survival. However, it is important to note that these are potential scenarios and not inevitable outcomes. The severity and duration of a recession would depend on many factors, including the policy responses of governments and institutions. To mitigate the impact of a recession, individuals, businesses, and governments can take various steps to prepare and adapt. For example, individuals can reduce their debt, build their savings, and invest in diversified and resilient assets such as gold, real estate, or education. Businesses can improve their risk management,